and welcome to this Risk Readiness webinar. I'm Ann Adams, Product Manager, Business Solutions at the Risk Management Association. Thank you guys for joining us, and I want to just share that RMA is proud to make this presentation complimentary to our members. If you're not a member, explore all RMA has to offer at rmahq.org. I just want to see if we still have some participants coming in before I turn it over to Tom. We still have quite a few coming in pretty quickly here, so let's just give it a couple more seconds. Okay, so today's webinar is the latest installment of Credit Trends in Commercial Lending, Credit Risk Navigator, presented by Tom Cronin from AFS. During the presentation, if you have a question for the speaker, please submit using the Q&A feature at the bottom of your Zoom screen, and we'll address as many of your questions as we can at the end of the presentation. So at this time, I'd like to turn it over to Tom Cronin from AFS, and thank you for joining us today.
Thanks, Ann, and welcome to everybody with us today. So if you've joined us before, you've heard me mention several times that I look forward to reviewing the surveys that you complete at the end of each of these webcasts. And not only am I checking to make sure we're providing what you want, but I'm also checking to see what new information would be beneficial. And recently, you've asked for more credit quality data. So today, as we review the April 2023 results, we have several of the standard charts that you like and some new, completely new charts that will focus on credit quality. So the source of our data is the Credit Risk Navigator, RMA Credit Risk Navigator, powered by AFS. CRN started in the third quarter of 2003 and has provided benchmarking data on commercial loan performance, credit quality, and loan growth measures throughout the recession, the energy crisis, and most recently, the COVID restrictions. And over the past 12 to 18 months, there's been a threat of a recession, and whether that'll actually occur is open to debate. But with the recent banking issues, high inflation, high interest rates, and low net interest margins, risk managers and banks need to be able to answer these three basic questions as we move into a more restrictive environment. First of all, what do I have? Secondly, how is it doing versus my peers? And third, am I missing anything, or are there any emerging risks? And the Credit Risk Navigator can help with all of these. As an example, though, just for one specific example, one of the ways you can identify emerging risk is to use the early warning webpage, which is what you see a copy of here, and specifically the past due tab, which is in the upper left. Now I've highlighted the lower left chart, and we'll take a closer look at that on the next page so you can see what sectors you would need to examine in more detail. So with this past due tab selected, you see past dues charts for both your, this is your bank, this would be your bank versus the peers. And then this is the top 10 worst performing industries. And here's what it looks like on the next slide. So you can see that if you're looking for what's emerging risks, what you want to stay away from, if you assume that the recession might come, even a soft recession, and would impact some of these markets, definitely two sectors that you would want to take a look at are 61 educational services and 92 public admin, because both yours, the peers, and the markets are all above 1% past due here. All right. And later on this year, either next webcast or the webcast after, we're going to go into a little bit more on the Credit Risk Navigator, kind of a live demo, if you would. So data-wise, we're going to start off with C&I, commercial and industrial loans. A quick definition of C&I. This is for borrowers' annual sales north of $1 million. Loans are for business purposes and are manually underwritten and risk rated. And the loans that are secured by what's called owner-occupied real estate are in here, are tagged as C&I. So we'll start off with one of our standard charts with a little twist. You see at the top, we're now calling this C&I non-performing and delinquency trend. So regulators frequently combine 90 plus days past due and non-accruals into non-performing loans. And you see that in a lot of your annual reports as well. And on this trend chart, we're showing the trend in short and medium-term delinquencies and non-performing loans, or you'll hear me call them NPLs, since 2003. So the NPL has been relatively flat for the past 12 months, hovering in the 0.6, 0.5 range. Compared to last April, short-term delinquencies, the gold line, have dropped 40 basis points to 0.38%, but are up from this February's 0.1%. So we're continuing to see the high levels of volatility in the short-term past dues that we've seen throughout this pandemic period. If you notice, starting back in the early 2020, past dues went up and down, very volatile. You haven't really seen this level of volatility since the recession. It's back down, but it's still very volatile. So because of that, we're going to concentrate today on the NPLs. And here, CRN has the ability to segment data down to the six digit, but we've just pulled the NPLs for April 22 and April 23 for NAICS at the 2-digit level. And a couple of comments. The first is the most obvious. The large increase on the left is also the worst performing sector, 11 ag. We'll talk a little bit more about ag, but primarily this is crop related. Other sectors of what I'd call emerging risk or areas that are under stress are the 23 construction, and within there it's flooring subcontractors. 31 manufacturing, we've mentioned this before, soft drink manufacturers. 56 admin coming over to the right is also up. And this has been for facilities management and investigation companies. The facilities management is related to office, which we'll speak about in a little bit. And then 61 education, which we just talked about a little while ago on looking at CRN database, primarily technical schools. Now here's non-performing trend for geography, and a quick note for the C&I portfolio, geography is based on the location of the borrower, not the bank. So if Bank of Vermont, for instance, makes a loan to Google, that is tagged as being in California, not Vermont. And over the past 12 months, the biggest change in non-performing loans by region has been the deterioration in performance for companies located in the South, followed by firms in the West. And there's a couple of reasons why we're seeing a decline in the South, and we're going to take a look at that on the next couple of slides. Before I get there, I will say that the decline in the West is almost 100% agricultural related. So on this slide, I gathered the non-performing loans for every industry sector for April 22 versus April 23, regardless of outstandings. And the jump in agriculture from 0.12 to almost 16.5% is not only the most noticeable, but it also obscures changes for the other sectors. And since the balances for the ag related industries in the South are small when compared to the other sectors, I thought it would be best if we make an adjustment that you'll see here on the next slide. And that adjustment is I've removed the agriculture data from the slide to get just the South without agriculture. And in looking at this, you can see how widespread the deterioration in the South actually is. We're seeing increases in non-performing loans for several large industries, and all these industries are what I would call statistically valid. You're seeing problems for 31 and 33 manufacturing, specifically soft drink and motor vehicle body manufacturers. 42 wholesalers are up, as are 45 retail. For 42, it's drug wholesalers. For 45 retail, it's pet supplies, which is a little bit surprising, knowing how much money I spend on my dog. 48 transportation, this is chartered freight air. 56 admin, another one that's up substantially, and this is for packaging companies, and 61 education. Again, as we've mentioned before, this is for tech schools. All right, now we're going to move on to credit quality. But before we do that, I want to turn it back over to Ann for our first poll question. So Ann, if you could launch that.
Sure.
So these are kind of technical or operational questions, if you would. The first one is, and since we're on credit quality, we wanted to see who assigns the initial borrower risk rating. And it could be more than one here, but we're looking to see whether it's the relationship manager, the underwriter, the loan review or audit team, or if you have an approving officer or an approving committee, if they're the ones that are assigning the ratings. So if you, or an other, sorry, I forgot other. So if you would go ahead and select that, we'll wait just a second and see what the results are.
Still some responses coming in. We'll give it another couple seconds.
Okay. And you're going to see a couple of these today, and they're all in the same vein. We're trying to understand who's responsible for assigning the ratings, changing the ratings, and then what kind of factors are you using? Because that'll help us to determine what we want to show. Okay. So by far, it's the underwriter. And then next would be the approving officer, with a little bit of the manager, a relationship manager. Okay, so thank you on that. So let me get to a couple of our new slides here, and looking at credit quality. And at the end, you'll see our email addresses, and you'll also have the chance to fill out the survey. So if there are things that we say here that don't make sense or that you like, or if you want to see more of, please feel free to either email me or mention something in the survey, because this is a little bit different from what we've been looking at before. So as I mentioned, in the last couple of surveys, end of session surveys, you've all indicated that credit quality was the very important management tool, and you want to see more charts on credit quality. So here's a chart that we created, and let me take a second to explain what we're doing. So in the Credit Risk Navigator, we map every bank's native borrower risk ratings to the RMA 10-point scale. And on that scale, borrowers rated 1 through 6 are labeled as pass, with 6 being low pass. 7 is special mention, 8 is substandard, 9 is doubtful, and 10 is loss. You'll hear 8 through 10 called classified, and 7 through 10 criticized. And our risk rating 6, according to the RMA definition, is defined as borrowers with declining earnings, strained cash flow, and increasing leverage, all indicators of above average risk. And since about 15 to 20% of the 6s go higher, and by higher, I mean into 7, 8s, or 9s, and that's from our CCAR study over a 2-year period of 2016 to 2018, I've tagged 6s as emerging risk, especially in light of the economic problems that we're having. So the 2 bars you see here are the combination of borrowers for tagged as emerging risk in the blue and borrowers tagged as criticized, the yellow and green and gray, for April 22nd, April 22, and April 23. And I referred to this as borrowers being in a credit distress situation. And the credit distress balances for April 23 make up a larger proportion of the overall C&I portfolio, as the outlook for credit quality has worsened versus just a year ago. As you'd expect, the 6s make up the largest portion of this part of the portfolio. In April, loans rated or borrowers risk rated 6 we're at 14.6% of the total portfolio. April of 22, that is. April of 23, that number is up to 16.2%. And the large jump in sixes combined with a smaller increase in sevens more than offset the slight improvement in eights, leading to an overall decline in credit quality. So we're going to take a deeper look at what's changing, but we want to jump into our next poll question. So Anne, if I could get you to launch that one.
Sorry, technical
All right.
difficulties. Trying to get to the other one. There we go.
Okay. So this one is the first one we asked, who can assign a rating? So this is who can move a borrower rating into a criticized rating. So that would be 7, 8, 9, or 10. So who can take it from pass and put it into criticized? And again, we have our 5 options: the relationship manager, the underwriter, loan review or audit team, the approving officer or approving committee, and then other. Not really sure what other would be, but I wanted to put that down there in case somebody actually had somebody else doing this. So we'll take a look at this. And this is, in my mind, interesting because a lot of people said it was the, in terms of approving, if I go back, it was the underwriter. Now I'm trying to see how involved the underwriter is as the loan matures. So go ahead and answer this one, please.
Okay, it looks like the responses have slowed down.
Okay. All right, so 34% relationship underwriter still involved, 68 loan review, 87%, and 4. Okay. So this is very interesting to me that the approving officer, a loan committee, 87% of the time in the under loan review. So it's definitely slanted more toward, out of the hand of the original approvers, the underwriter, and the relationship manager. So very interesting. All right. Okay. So we're going to go now and look at emerging risk and criticize. Again, I'll just be calling that distressed. And look at it by the industry sectors, 2-digit NAICS level, April 22 versus April 23. And I'm going to start, with the sectors that are better off. And it's going to be a short conversation, as there are only 7 sectors that had an improvement in their ratings over this period of time. The best or the most improved, starting from the left and going to the right, are 21 mining, oil, and gas. And the subsectors within that are oil and gas extraction. 48 transportation, cruise lines. You remember how hard they were hit when COVID first came about. And then 55 management of companies, the holding companies, which is the big conglomerate catch-all phrase, actually are doing better. Worse off this time around, 23 construction, a lot of civil engineering and subcontractors, 32 manufacturing, pharma was in there, which I thought was interesting given the problems we saw with drug wholesalers. And of course, 11, agriculture, and this is almost totally related to crops. And aside from the specific sectors that have declined, I think what's most interesting about this chart is that over the past 12 months, we've seen a period of stable performance. If you remember the NPLs and basic direction of the past dues, they've basically been stable. But yet, if you look at the ratings as being predictive, the forecast is that the benign performance will be ending. Banks are very clearly expecting problems. So with this next chart, I wanted to expand our analysis of credit quality a little bit. And here we're looking at the weighted average risk ratings for each 2-digit NAICS code. So it's a little broader than just the distressed portion of the portfolio. And again, we have the results for April 22 and April 23. And you can see the changes are not as dramatic as what we just saw, as we're dealing with much larger overall portfolio. So these things move a little bit slower. There is one increase for a sector that does not show any performance issues. And we've been monitoring this sector for a while now, probably 3 or 4 years, if not longer. And it's primarily we've been monitoring it primarily due to its substantial growth over the past few years. And that's 52 Finance and Insurance. Within 52 are the private funds that are lending to leveraged companies. And if you're looking for a dark horse sector that would react negatively to the higher interest rates on the C&I side, this would be it. And a great example of this is a recent Chapter 11 filing by Envision Healthcare, which had been backed by private equity firm KKR. And that's going to result in a $3.5 billion loss. So this is something that we've been keeping an eye on and think it's very interesting that you're starting to see it creep up. All right, so we have one more poll question. And this, I'll wait till Ann brings it up. Again, this has to do with moving borrowers into criticized rating. And here is multiple choice. You can select what are the reasons for moving a borrower into a criticized rating. And that could be a change in financial, and I didn't put it here, but it could be a negative change in financial, obviously. A significant delay in payment, a serious covenant violation, a change in industry conditions, similar to what we saw in 2016-17 with the energy crisis, a change in borrower management, or just a change in overall economic conditions, or again, the other. So we'll just wait and see what you have to say on this. And part of the reason I've been asking this, specifically this one, is to get a feel for how we might shape some of these credit quality charts going forward. Just to give me an idea of what's important to you.
Okay, looks like it's slowed down with the responses.
Okay. All right, 94% change in financials. Payment, 83. Okay. So it looks like the first 3 I put there were the 3 most important. Okay. All right. So we're going to finish up C&I by tying together performance and credit quality with this scatter chart. And on the horizontal axis, we had the non-performing for each industry sector. On the vertical axis, we have the weighted average risk rating for each industry sector. And we've talked quite a bit about the relation between performance and ratings, and that often there is not a match. But you can see from the trend line that we've added here that overall ratings tend to move in tandem with performance. Again, as Jeremy has mentioned in his commentary here, it's somewhat imperfect, but there is basically a positive correlation. And at the extremes, the dot on the far right is ag. The dot on the lower left is public admin. And ag is the worst performer and the highest rated sector. And public admin is the best performer and the lowest rated sector. And if you would like the actual data behind this chart to see what these individual industries are, please feel free to email me and I can send those to you. So now we're going to move on to CRE. And I'll define CRE first before we get in, make any comments. For CRE, we match the interagency guidance. Basically, that says if more than 50% of the loan repayment comes from the proceeds of the sale of or the rental of the property, it's CRE. And you'll also hear this referred to as investor-owned real estate, as opposed to the owner-occupied. And we've done the same thing here for CRE as what we did for CNI. 90 plus days delinquent have been added to the non-accruals to create non-performing loans. For NPLs, similar to what we saw with CNI, we saw a jump with the COVID closures and then a slight recovery, but now we're up 33 basis points over last April, and we've been above 1% since late last year. And if you look, and you remember back to CNI, CNI went up, NPLs then came down, is actually back down to where we were pre-recession. What you're seeing here with CRE is it went up, it started coming back down, and then mid-22, it started going back up again. And we are nowhere near where we were pre-recession. Delinquencies again have fluctuated, but it's about back to where we were. So I think it's best that we take a closer look at what's going on with the NPLs. And it's really two different stories. You'll see here in a second. So here we've pulled the non-performing statistics for the 8 largest property types. And when I say largest, I'm referring to outstanding balances. There are other property types in CRN. These are the 8 biggest. So for a relevant standpoint, this is what you really want to be looking at. We have a column, a blue column for April 22, and a gold column for April of 23, side by side, so you can see any changes. And you see big jumps for offices and also for healthcare. We're going to take a deep dive into offices in a second, but I did want to mention for healthcare that the problems appear to be on 2 fronts. For some time, we've heard of the decline in occupancy for assisted living facilities that was actually happening even before COVID, obviously exacerbated by COVID. Starting to come back a little bit, but still a lot of occupancy in assisted living facilities. But in addition to the senior living issues, at several RMA roundtables, I know Stephen Martin and a couple others have informed me that they're hearing now that doctors' offices are struggling primarily due to staffing issues. As you probably were aware, the COVID issues were very hard on nurses and supporting staff. And a lot of those people have left that industry and are not coming back. And doctors are having a hard time scheduling patients because they just don't have enough people to support them. So that's something we'll take a look at going forward. And these 2 large sectors, healthcare and office, have offset any improvement that we've seen in lodging. And you'll note here that the lodging improvement has kind of stalled. We've mentioned before that this is primarily due in the big cities. There was some dramatic improvement, but that's kind of stalled. And now we're seeing issues with healthcare and offices. So we want to talk a little bit more about offices. And here we have the trend in non-performing balances. You see the tremendous drop from the recession down to 0.18 as of December 19. At first with COVID, it was pretty flat. Then last year, we saw a big jump and starting in around June. In June of 22, the non-performing loans for offices was 0.27%. It's now at 1.77%. And as I said, there's been a lot of press about offices lately and the problems, but CRN was warning you of this a year ago. And so this is a good example of why it's beneficial to be in the CRN database. You would have seen this start to happen a year ago and been able to jump on it. So here's the risk rating mix for office properties. Again, the top line, April 22, the bottom, April 23, top bar. And in 22, the investment grade, which are the risk ratings 1 through 4, so the dark green and the blues, was greater than 40%. In 23, investment grade has dropped to about 37%. 5s have contracted quite a bit, and 6 have gone up quite a bit as well. And a huge pickup for 7s. and you can see the 8s have almost doubled. So to me, this is, from a visual standpoint, you can see how much of the yellow has come into the picture on the bottom slide, the yellow being the 6, and then how big the red has gotten. So for office properties in just a year's time, the credit quality has really suffered. I wanted to look at the size. We occasionally look at the size of loans. And so this is the non-performing ratios for office properties by size. And I wanted to do this to see what kind of impact are we talking about? If these loans end up, obviously they're in non-accrual or they're past due, and you end up losing them, how big an issue is this going to be? And ignore, if you would, the less than 100,000. That's very few, and kind of noise, if you would. You can see that the majority of the dollars here are for the large loans. So these are going to be very significant losses if they were not, the loan to values were not well thought out. And even then, you've seen a lot of descriptions lately about the decline in office value. So even if you had a good loan to value based on your latest appraisal, that value might not be actually what's there. So your loan to value might be in reality inflated or underinflated. Underestimated. How about that? All right. Non-performing ratios for office products, for office properties by product. Again, I just want to get a feel for what we're talking about. Term loans a little less than 1, but construction loans are in a distressed situation. 5% of construction loans in a distressed situation. And that, to me, is troubling. That means a lot of these things are not even leased out, and they're already having problems. One last look at offices, and this is by geography. Here we're looking at location, and a quick note: in commercial real estate, unlike C&I, location is based on the property. So it's where the property is actually located, not where the borrower is located or the bank. And the CRN data has shown dramatic increases in non-performance in several regions, most notably the Eastern Midwest, and that's the Chicago area, Mid-Atlantic, Philly and DC, I remember correctly, and then Northeast, New York City and Boston. And I think you've seen a lot of the CMBS special servicing loans going into special servicing in these areas. And CRN has the ability to see down to the zip code level. And we're in the process of conducting analysis at that level to see if there are any variations by market within these regions. But that data initially will be released to members only. So that's another plug to join the database. So here's the stress mix for CRE loans, April 22 versus April 23. And you see a jump for every risk rating, with the highest jump for the 6s, up from basically 17% to almost 23% in just 12 months. And it's very easy to see that the overall increase for CRE is much larger than what we saw with C&I, which signifies that the outlook for CRE is not favorable at all. So we're going to conclude with a look at the distress balances as a percent of total balances by property type. And the only positive is lodging, although that property still has half of its balances tagged as what I'm calling distress. So I thought that was sort of depressing that that's the only good news I could tell you. We're seeing increases in distress balances for every other property type, with the largest bump for residential, in my mind, probably due to the reaction to high interest rates. But you're seeing increases for healthcare, industrial, multifamily, office, a little bit for retail. Every single property type, with the exception of lodging, the forecast is not positive. So that concludes our presentation today. And Ann, I'll turn it back to you for questions.
Thank you. Yes, we do have a couple questions, so let's take. The first question is, will we be sending out copies of the slides? That's a yes. Oh, someone had a problem with the poll. I apologize for that. We can look into that later. And I think too, if there isn't just for some going in the future, if there is something, maybe you can use the hand raise button. That'll help us maybe be able to address that in the moment. And then also another one, yes, we will be sending out the slides. So that really covers the 3 questions. I don't know if there's any other questions from the audience that you'd want to direct to Tom.
And again, I just mentioned, if you have any comments at all on the what we're calling distress loans or anything on the credit quality, please feel free, pardon me, either email me or make a statement in the survey that follows.
Great, thank you. Unless there's more questions, thank you to Tom for sharing your insights, and thanks to everyone for joining us today. We look forward to having you at our next session on credit trends. And
Thank you.
Thank you. This concludes our webinar. Please take a moment at the conclusion of the event to complete the post-webinar survey. Thank you and have a great day.